Thank you all very much. It's absolutely a pleasure to be here. It's a long way to come here. Like Louise, I came a great distance. I was a little surprised, I guess, because when I was first asked to do this, I live in Connecticut, just about 50 kilometers outside of New York in a small town in Connecticut, so southern New England. And I was pretty sure when I was originally asked that it was the Insurance Council of New England that I was going to go to. So I thought I'd have a 3-hour drive to Boston. And the good news is I can't understand anything anybody says in Boston, so it's a lot easier to be here in New Zealand. I'm really pleased to be here, and I want to spend some time today talking about our industry, both the insurance and the reinsurance industry, although I'll have probably a little bit of a bias towards the reinsurance industry, and talk about the dynamic nature of our industry. I think that it's sometimes underappreciated, the dynamicism of what we all work in every day. And then talk a little bit about some of the constant factors for success in our industry. So we talk about the dynamic nature of it, and then some constant or almost static aspects of what it takes to succeed in our industry. And our industry is changing so much every day right now. Some of the things that you just heard talked about in the last session in terms of everything from regulation to telematics to things that are having constant forces pushing in on the industry, affecting it and causing us to react to it. So I'll start with our brief, there we go, our proprietary notice, which basically says that this is prepared for informational purposes. We'll share with you, to the best of our knowledge, what we believe to be true. And if it's not, then you can't hold me to it, I guess. So we talk about a dynamic industry. One of the key issues that you see and that all of you have heard about is the amount of new capital and alternative mechanisms that are entering our industry. So I'll spend a little bit of time talking about that. I'll talk about mergers and acquisitions, something that has been a very material dynamic this year and last year, as we've seen a number of mergers. We've seen a variety of M&A activity, and something I think we'll continue to see as we move forward. Decision analytics, which relates to telemetrics, and it relates to a variety of ways in which we're gathering information and trying to make better decisions as insurance and reinsurance organizations. The investment environment and the impact that's having on how we run our business. Modeling, something that, while maybe a part of decision analytics, is also something that's continuing to evolve and change and assist in the way that we look at risk across the industry and around the globe. Emerging issues, and not so much specific emerging issues, although I'll list a number of them, but more about the process that we have to look at as an industry in order to address issues that are emerging and that affect the way that we accept risk and ultimately underwrite risk and provide coverage for risk. And finally, regulation and the impact of that on our industry. So let's start with new capital and alternative mechanisms. Insurance-linked securities. Insurance-linked securities, there were $8.3 billion of insurance-linked securities issued by insurance companies in 2014 alone. And $5 billion, or that was 27 transactions, but $5 billion of new transactions in the first 6 months of this year. And the expectation is there'll be over $7 billion of insurance-linked securities issued in 2015. In force at the end of last year was $24 billion, which was 20% increase over 2013. So you can see there's a lot of activity in this space. And I'll be the first to say that I believe that the alternative capital and insurance-linked securities are here to stay. But the means by which they'll stay or why they'll stay may change over time. We'll talk a little bit about that. Here's why there's so much activity. There's healthy investor demand. Basically, investors are looking for ways, seeking yield, higher yield than they could otherwise get from other fixed instrument securities or other fixed instrument investments. There's been low loss activity in recent years. So as they've looked at the history or the experience of these investment vehicles, which are largely related to catastrophe bonds, there's been low loss activity. So investors have actually done well in terms of the return and the expected return relative to what they would have received from other fixed income instruments. 90% of these instruments have to do with hurricane, dominated by U.S. hurricane, but it's expanding and diversifying around the globe. I know that there are companies here that are using alternative mechanisms in order to buy catastrophe coverage now, similar to what they would have bought from the traditional reinsurance marketplace. And you can see the diversification in Canadian earthquake, Japanese earthquake and typhoon, Caribbean earthquake, Turkish earthquake, healthcare claims, so expanding outside of the traditional P&C world, as well as European windstorm. So you're seeing, greater diversification, greater use of these tools, again, all in desire to seek higher yields than what would otherwise be available or relative to some other instruments, other financial instruments. I think the thing, though, to keep in mind is that we've been in a very benign period in terms of catastrophes around the globe. And many of you know that in our industry and have experienced that and have benefited from it in terms of the results of your organization. But there has not been a hurricane making landfall in Florida since 2006. So we've had a 9-year period without a hurricane making landfall in Florida. That hasn't happened since 1850. So when you look at what the most recent history and experience has been for these sort of instruments, you have to ask yourself about the experience versus the exposure. If you look at the 10-year average for catastrophe events, you can see the most recent 3 years have also been very low periods in terms of catastrophes. 2013, 29% below the average, the 10-year average. 2014, 38% below the 10-year average. And 2015, the first half of it, 47% below the average. And not much activity in the second half of this year. But again, that's the most recent experience. When you look at exposure, you only have to look back 2 weeks. The exposure exists. Hurricane Patricia was a record-breaking hurricane that made landfall on the Baja Peninsula of Mexico. Over 200 mile per hour wind speeds, the lowest barometric pressure ever recorded, an absolute monster event that caused very little insured damage because of where it made landfall. It basically threaded the needle between higher population, higher exposed areas. So the industry didn't suffer anything from this event. The experience will still be good, but the exposure still exists. Interestingly, there is a cat bond that will likely be triggered by this. The all-cat Mexican cat bond will likely lose 100%, it has 3 different tranches, but its C tranche will likely lose 100% of its principal if it's confirmed that the barometric pressure hit 920 millibar, which is what has been reported to this point. So this has nothing to do with indemnification for the insurance companies. It simply has to do with a financial transaction that will result in a very large sum of money being paid by this bond, investors and this bond being downgraded by S&P to D level if in fact that's confirmed. So once again, it's exposure versus experience and a financial instrument versus indemnification that we usually see in a reinsurance transaction. So it's a reminder that we can't be complacent. In our industry, we have to recognize that those sort of exposures are still out there and that we have to think about them every day and cannot relax in terms of how we approach our business. And you need not look much further than some of the things you may have heard, you will hear about actually later today and that you have heard about in terms of things that are happening around the globe. Land and water temperatures continue to increase. And I'm not about to get into the political debate as to why that's happening. But we can look at, for the last 150 years, the increase in temperatures that we've observed. I know that Tim has gone back and looked even further than that in terms of the type of increase that we've seen over time. So we know that the world's getting warmer. The world's also getting wetter. There's been a lot of speculation as to why there's been so many hail events around the world in terms of North America, Europe, Asia, as well as Australia, the increase in hail events. So we have increased precipitation around the world, and we've seen that increase over a long period of time as well. And we see sea levels rising. By this rate, a little over 3 millimeters per year. Interestingly, when I went back up to my room after dinner last night, I turned on TV and they were talking about exactly this. So as we continue to see warmer temperatures, as the polar caps melt some, that we continue to see sea levels rise. So we've got exposure changing in terms of the environment that we live in. And what does that mean relative to experience that we've looked at previously? So again, balancing what's the exposure versus what's the experience, and how does that relate to a lot of things that are being offered out there in terms of alternatives to our business, as well as how we look at the business and the fundamentals of our business. So if we look at some of the entrants into the business, we see, excuse me, that there are a variety of investment theories investment theory is somewhat being twisted in terms of the way that some of this financial or alternative financial markets are participating in our business. That diversification, correlation, discounting of rates, float, and scale are things that they are promoting in the process. So let's look at some of those. Diversification, first of all, by itself is not a strategy. That diversification, the diversification of risk is operationalized by the entrance into a market, and that the dynamics of that market or the behaviors of that market can trump a diversification. Market behavior, in other words, that you have to underwrite in consideration of the market and cannot rely on diversification simply as a result of participating in that market. You have to understand the risk that you're assuming and not just be a part of the market in order to successfully benefit from diversification. So that diversification is a byproduct of a well underwritten book of business rather than simply a result of participating in the market. And then we see a lot of, in terms of correlation, there's talk about whether or not there's correlation between these new alternative investment vehicles when compared to traditional investment vehicles. So we see a lot of pension funds that are participating. And they're participating in the market, as I said, because of the yield that they seek in order to get more yield than they would as a result of other investment options that exist for them. And so risk margins, though, however, are being compressed as interest rates continue to be at record low levels, as there's more competition within the market space, as there is greater both competition from both traditional reinsurers' desire to continue to be in the space, as well as alternative capital in the space, that you continue to see pressure on those margins, and you continue to see more and more of a question in terms of the result that they will achieve. But it's represented as a non-correlated asset, that it's not the same as other assets across other financial instruments, and it doesn't relate to that. I would say that if we have the event, like a Hurricane Patricia, an event that occurs in a more populated area, where the exposure suddenly is something greater than what was recognized just by experience in recent years, then you will see a higher level of correlation. Karen Clark Associates in London said that if Hurricane Patricia had hit in South Florida, we would have a $200 billion event instead of a $200 million event. And I would say that the correlation then goes closer to 1 in those scenarios, and that we find that there is a risk of correlation, or there's much greater correlation of assets between traditional investment vehicles and those of these alternative vehicles. Then we also see hedge funds entering this market space. And the hedge funds basically represent themselves as providing low volatility reinsurance as an alternative investment solution. Reality is there's no such thing as low volatility reinsurance. I've been in this business, as was represented, 26 years in the reinsurance business, 30 in the insurance business. And reinsurance by its nature absorbs the volatility of the primary insurance companies. So as you can see from this chart, reinsurance results over this period of time tend to have much greater spikes related to volatile events, and you see, which is the blue line, and the orange line represents the insurance industry, which tends to be a little bit more stable in terms of the results. So the fact that they're talking about a low vol solution for reinsurance or as an alternative to traditional reinsurance doesn't make sense when you look at how the industry has purchased reinsurance and has benefited from reinsurance over time. So they also talk about more aggressive investment strategies, that they're selling or promoting more aggressive investment strategies, the higher returns to credit the liability side of the balance sheet, and also to allow them to credit pricing in terms of the underwriting side of the transaction. In reality, this is double counting. The return they are getting on the asset side includes the risk of investments. The additional return is for that riskiness of investments, and they are using that risk to subsidize the way in which they're underwriting. The only appropriate discount rate is the risk-free rate in order to discount relative to their pricing, not the investment in more risky assets. And by the way, many of these organizations have discontinued accepting new business this year because both their underwriting results and their investment results have underperformed relative to expectations. And I think it's just an example that shows how challenging our industry is. That just deciding to be in our industry to accept risk and then ultimately benefit from the investment side is very different than the experience, the expertise, the knowledge, and the understanding of the insurance business or the reinsurance business that we have in this room and that we have in the traditional marketplace. The reality is the hedge funds basically have the ability to place $1 billion or more offshore to get their 2 and 20 return, so basically 2% of assets invested, 20% of the investment return. They get tax-free buildup for a period of time, then they can re-domesticate and pay capital gains taxes rather than traditional income taxes. So it allows them a vehicle to basically get a different return, and it's an investment vehicle. It's not a traditional reinsurance vehicle. It's an investment transaction versus a reinsurance transaction. And then the question is the time horizon and resiliency of these alternative mechanisms as we see interest rates increase over time, and I'll touch on interest rates themselves in a little bit. One of the other issues that they talk about is float. And floats, it's a great thing in terms of our industry, in terms of our ability to accept money and hold on to it over a period of time, either in terms of reserves or unearned premium. But there's good float and there's bad float. Good float comes from good underwriting. It comes from basically taking on risk, taking on that premium, understanding the exposures you have, and then having that for a period of time. Bad float is float that is derived when you write a lot of business that you may, in fact, not pay out for a long period of time, but you underestimate the cost of that over time. So that even though you get the investment return, you don't get enough to overcome the cost of the losses. So you still have to have the ability to have the underwriting expertise to allow you to be successful in terms of the benefit of that float. We saw similar activities taking place in the 1980s in terms of Xerox, Leaseco, GE, and ITT basically participating in the insurance marketplace. None of them participate today. Only Lowe's does in their ownership of CNA. And that was referred to at the time as cash flow underwriting. So taking in funds, holding those funds, investing them, even if you were doing it at an underwriting loss. Today we hear about total return underwriting. You see Exor, Fosun, Futureland Development Holdings, and China Minxing Investment Corp. Basically doing the same thing. It's a different name, but the same result. And if you look at Futureland Development Holdings, this is something that was in IBNR Weekly a few weeks ago. They said, we are studying investments in insurance companies, banks, and the like. Liquidity from an insurance company can complement any cash flow shortages or needs in the property business. So they're basically saying they're going to use the insurance funds to meet the cash flow needs of their real estate business. The better part of this was the second point, rule number 1. If this is your plan outside of China, don't tell your policyholders and insurance regulators or the rating agencies. I mean, our business cannot be translated into something that is a financial instrument for the purpose of solving another business's problems. And this is what you're seeing with some of these alternative vehicles and the way that they want to use insurance industry float in order to operate their organizations. We see a lot of M&A activity, as I mentioned earlier, and we've seen that over the last year. It's been very high. Many feel there's a likelihood it will continue. What's interesting about recent deals is the valuation. Many acquirers are willing to sacrifice shareholder value in order to meet strategic initiatives. The biggest question is whether or not that will ultimately create shareholder value in the long run and whether it'll meet those strategic needs. McKinsey & Company basically looked at M&A activity in 2010. They did a study, and they found that 50% of mergers and acquisitions did not result in shareholder value creation. So when you look at the activity, I would argue that much of it relates to scale, a desire to be larger organizations, not necessarily a desire to meet a strategic need, and that in some cases, in fact, one of these cases, the company that was acquiring another referred to it as 1 + 1 = 3. When you look at the competition that exists in our marketplace, it's very difficult to imagine that 1 + 1 is going to equal 3. It's challenging enough in a merger to have 1 + 1 = 2. I'm sure many of you have been through mergers, the amount of distraction, the amount of effort that requires in order for it to be successful, to merge two cultures and two organizations, that some survive and do very well, others don't do as well, and that's consistent with what McKinsey has said. So, it's one more dynamic that's infecting our industry, that's causing change within our industry. Decision analytics. This is a high-speed race for P&C reinsurers and insurers. It's something that is transforming our industry, something that is going to change the way that our industry operates in the future. It has an abundance of challenges in terms of collection of data and the validity of that data, making sure that we have the right information, that we're gathering it, that we're ultimately making the right decisions related to that information. It's resulting in cultural shifts within organizations, the way that we've done things in the past and the way that we'll do things in the future. Its acceptance, both internally and externally, is somewhat challenging at times. Everything from internal associates, employees, and groups and the way they've always done things, to policyholders and regulators. And there's questions about privacy. But it has transformative value from a marketing standpoint, from an underwriting standpoint, from a claims management standpoint, and from a general management standpoint. Decision analytics over the next 10 years will transform our industry and the way that we operate on a day-to-day basis. It's something that, as an industry and as an insurer or reinsurer, you cannot afford to forego. You'd be at a competitive disadvantage without it. The potential to be selected against becomes quite high, as well as it changes behavior. It changes behavior in terms of how you operate and how you make decisions. It also changes behavior, if you talk about telematics, in terms of the way that people operate if they know that they're being watched or they're being monitored. So if you forego this, the potential for you to be at a disadvantage is quite high. The interest rate environment, something else that's having a meaningful effect on our industry as a result of the global interest rates for an extended period of time being at record low levels. That we see for the last several years the impact of interest rates. This is the U.S. federal funds rate, but it's consistent not only it's in the U.S., but it's also consistent with many other developed economies around the world in terms of what's happened with interest rates. So insurance companies and reinsurers, as they invest over the last several years, as bonds have matured, they've moved money from higher yielding instruments to now lower yielding instruments. And so the impact in terms of the return on their investment continues to decline. And as a result, as we go forward, this is what you can see what the return on investment has been for U.S. property casualty industry. And again, I think it relates globally. As we go forward, you see that decline, you see the consistent decline over the years, and an expectation that 2014, 2015, 2016, that we're going to see that same low level of return on invested assets across the industry. Modeling, more and more a developing part of our marketplace, certainly a part of decision analytics, something that we've all been using for the last several years and something that continues to mature. Modeling still is developing. Additional data is being developed all the time. There's a lot of unknown exposures that still exist, and certainly New Zealand's aware of that in terms of modeled fault activity or the lack thereof in recent events. And it's an imperfect science, but it is a science that's continuing to change the way that we look at risks that we're assuming and the way that we manage exposure across our industry. Emerging issues. Maybe the one that's at the top of the list here, cyber, is one that we as an industry have to get our hands around, that we have to address. It's one that's going to continue to be more and more of an issue for consumers and for our insureds. Yet it's a very challenging issue, everything from data breach to true cyber coverage. But these other ones are these are 9 emerging issues that are on a long list that we have within our organization of emerging issues that continue to develop and that we as an industry have to respond to. And the point here is that our industry will constantly have these. And what is the process that we have in order to evaluate, assess, ultimately to assume risk related to them and many others? And finally, regulation and oversight in terms of the dynamics affecting our industry. Solvency II, its impact around the world, ORSAs that are having to be done in multiple jurisdictions, and even jurisdictional differences and conflicts that exist between jurisdictions. So in some cases, what one jurisdiction may require may be completely opposed to what another jurisdiction requires. And how do you as an organization respond to that? And our chief risk officer provided me with this map related to regulatory issues that we look at. And it just shows the incredible complexity and continued evolution related to regulation and how it's impacting our business. And it's something that's going to continue to change, to continue to evolve, and to continue to challenge all of us. So what are the constants for success related to our industry? One is discipline. And I talk about here as far as underwriting discipline. We need to maintain the underwriting expertise that we've developed, and that we need to continue to foster that and build upon that. We need to maintain pricing diligence. I talked earlier about exposure versus experience and understanding the difference between the two. We need to have the courage and conviction in the decisions that we make. We need to have risk knowledge, and we have to have a healthy respect for parameter risks, the risks that are outside of what we know and what we price for, and the recognition that losses emerge in our industry outside of what was expected. And underwriting discipline sometimes can be really hard. Maintaining discipline, and when there's a lot of market pressures and temptations to do other things, can be difficult. And reserving discipline. I think this is sometimes the most underappreciated aspect of our business. Appropriate recognition of liabilities across what we do on a day-to-day basis and the risks that we assume, timely establishment of reserves, claim management expertise, and pragmatic actuarial assumptions. If we don't get reserving right, we put our organizations put them at significant risk. The fact of the matter is, if you've under-reserved over a period of time, you tend to over-report profits. You probably overpay taxes. Depend on compensation structures, you may overcompensate associates. You probably continue to underestimate the cost of the risk you're assuming and ultimately not price your risk correctly. If you look at the reinsurance industry, and this is a group of global reinsurers, for the business that was written from the period of 1998 to 2001, and their failure to recognize the losses that were emerging across their industry during that time. As you can see, at year-end 2002, they reported just over 100% combined ratio. Not a good number, 100% loss ratio. Not a good number to begin with. But it took them essentially 7 more years to fully appreciate the level of losses that they had assumed during that period of time. So during that period, they failed to recognize the losses they had assumed during that 4-year period prior to that. And as a result, they may have made some of the errors that I mentioned a moment ago in terms of the assumptions relative to the losses that they expected to have during that period. And this shows across the entire insurance industry during a period from 1998 to 2013 and 3 different periods, both soft market and hard market years, the initial loss selections, which are shown in blue, versus what losses ultimately developed to, which are shown in shown in orange. And as you can see, during that period from 98 to 2002, much like the reinsurers, the industry had underestimated losses that ultimately emerged. In a period of higher pricing, better terms and conditions, at least from the industry standpoint, you see a period where the initial loss selections are above what they ultimately developed to. And that's the period that they're talking about today, or they have been talking about the last several years, where companies' results have the companies have reported positive results because of their ability to harvest from those prior accident years, that they've had favorable development from those years, which has allowed them to report strong results in recent calendar years. But you notice a change that occurs in around 2009. Basically, there's an inflection point there, and you see that the initial reported reserves, or initial selected reserves, are now once again below what reserves are developing to. History would say that reserves that are initially undervalued continue to get worse over time. So if these were initially undervalued, which would be the indication from this, that the likelihood of them to continue to underperform, for them to continue to develop unfavorably, is pretty high. So you're beginning to see maybe the impact of that in terms of some industry, or some companies reported results in the second and third quarter, as they have not reported as favorable results, especially large global insurers. They have not reported as favorable results as they have in recent quarters because they're not getting the benefit from those prior accident years that they were getting previously. So this is something that we'll continue to watch as an organization, and I think the industry will continue to see how the industry evolves relative to this. Expense management. Understanding the total cost of the product and having the total cost discipline. Understanding where we can make efficiency gains in our industry through the use of technology and other means that we can better cut the cost of our distribution. Modified distribution and technology investment. So here's a look at expense ratios. Again, US P&C, and I've used the US P&C data because it's the best data we can get our hands on frequently. So if you look at the US P&C data, you see periods of time. The period 2001 to 2005 was essentially a hard market period, a soft market period after that, and now you see somewhat of a reduced expense ratio in recent years, as you've seen some in the primary industry, some in rate increase as a result of the need to get some rate relative to what was happening from an interest rate standpoint. So you get some sense of the troughs and the peaks of expense ratio over time. But as you look at the most recent years, you're not seeing as much of a directional trough as you saw in earlier periods and in harder market times. So the industry has to look at how it can improve efficiency and expenses. If you slice up every dollar that we collect as an industry and you split it between loss ratio and expense ratio, there's the ability to influence each of those sides. Loss ratio from a decision analytics standpoint, as we talked about, but from an expense ratio standpoint, we have to continually look at distribution. You're seeing disruptive methods being used today in terms of distribution of insurance products, and the ability for that to ultimately be challenged and to change the way that we distribute our product and ultimately how insureds buy the product, so it's a more cost-effective transaction. This, when we talk about all the things that technology is allowing us to do, will be transformative as well over the next 10 years. And finally, talk about the human resource management. We talk about in our organization all the time that when we hire somebody, it's $1 million decision. That no matter what their compensation level is, by the time you look at what we do from a training standpoint, what we do from a compensation standpoint, what we do from a development standpoint, and ultimately benefits on top of compensation, that if we have that employee for any period of time, that it's $1 million decision. So we need to continue, as an industry, we need to continually train and invest and develop our people. We need to make sure that we have the strong cultural adherence to the fundamentals of what success, delivers success in our organizations. And we need to make sure that we have the right performance management to allow us to succeed. So when you look at the industry, as I said, there's a variety of dynamic issues affecting us, but there's a number of constant and static issues that we have to continue to focus on as far as fundamentals of what we do on a day-to-day basis. And those the last few slides represent those fundamentals and how they allow us to succeed. So with that, I thank you, and I'd welcome any questions from the audience.
It's on? Yes, there we go. Chris Nell from Vero. I just wanted to ask a quick question. You didn't touch on the fact that a lot of the larger global carriers have also decided to take a lot more net risk. And I was just wondering if you could explain a little wee bit about the impact that's had on your business and also what your outlook for that is as we start to see the market change.
Sure. You're right. There's certainly been that movement in recent years, and I think especially, I think the industry overall, we've moved from, as reinsurers, oftentimes participating in working layers to more volatile layers, which is represented in that one slide. And I think we certainly understand the desire for companies, as they've had objectives, to retain more net premium, especially in a competitive marketplace. So, from our standpoint, what we've tried to do is recognize what buyer motivations are and what it means in terms of the volatility of the risk that we're assuming. I don't think that it's up to us to change the behavior of our buyers in terms of their desire to retain risk, but to make sure that we understand the risk we're assuming in terms of that volatility, and that they understand the risk that they are now assuming in terms of additional risk, especially at a time when the marketplace has become more competitive. I think that how that plays out over time will be interesting to see. I think primary companies have a lot more knowledge than they used to have, and probably the decisions they're making are very good decisions for them in terms of the risk that they're assuming. And for us, it'll continue to be more volatile.
You spoke about disruption. So what are your views on the potential disruption the likes of telcos or Google could bring to the insurance market as a result of the acquisition of big data?
Yeah, and that's something I think that when you look at the amount of data that they are collecting every day and their ability to ultimately utilize that, I think if you look at technology in our industry, that we have trailed other industries. And so the ability of organizations like that to use that information when we talk about distribution, when we talk about, what they're doing with autonomous vehicles, what they're doing in terms of understanding data analytics and what sort of behaviors people have, I think it has the potential for tremendous disruption as we go forward. And as an industry, if we're not paying attention to those same sort of things, then that ability to collect data and the ability to make better decisions and the ability to look at distribution, then I think we're kidding ourselves in terms of our ability to be as sustainable as we hope to be.
All right, well, we'll leave it there. Thank you very much. We'd
Thank
like
you.
to give you this to take back to New England to
Yeah.
show them what New Zealand actually looks like.
Great.
Yeah.
Thank you very much.
Thanks
I
very
appreciate
much.
it. Thank you.